So what happens if a bank fails? Let's say, in a hypothetical scenario, we have a massive run on the banks and Wells Fargo fails. The Bank of Montreal fails, you name it. What happens at that point? Is all your money lost? Well, that's when the FDIC comes in. The FDIC stands for the Federal Deposit Insurance Corporation. They serve as an independent government-affiliated corporation within the U.S. that insures deposited money at U.S. banks. That hypothetical scenario we just talked about where we have a run on the banks and everyone tries to take their money out at the same time. This agency was specifically created in 1933 to avoid those types of situations after the Great Depression happened. The US government needed to instill confidence in the American financial system, and that is exactly what they did with the FDIC. So the FDIC covers up to $250,000 in cash deposited at your bank. So if you have less than $250,000 sitting in an FDIC insured bank, you're covered. You don't have to worry about that money because in case the bank does end up failing, the FDIC would cover your principal and any interest you accrued as long as the total is $250,000 or lower. And this is automatic. As long as your account is at an FDIC insured bank, there's no need to set up anything extra on your end. So what in entirety does the FDIC cover? These lists are from an insured deposits brochure that the FDIC offers, and they cover checking accounts, savings accounts, money market accounts, certificates of deposit, and so on. Most accounts you can have at a bank. Now it's worth noting that credit unions are covered like banks as well, but they're covered by a different entity, the NCUSIF, which is the National Credit Union Share Insurance Fund. That fund also covers up to $250,000 in potentially lost deposits at a member credit union, so that's the difference to take note of. And what does the FDIC not cover? Well, here's a list they provide, and essentially they're saying that they don't cover investments like stocks or bonds, life insurance policies, and safe deposit boxes. Investments are actually covered by a different entity called the SIPC, and we'll talk more about them in my next video. So how do we know if our bank is listed and insured with the FDIC? Well, that's pretty easy. You can either look for their disclaimer on the bank's website, or you can go to the Bank Find suite on the FDIC's website. You can just look up a bank's name. You can see if your bank is FDIC insured. Now let's say your bank does go bankrupt for whatever reason. How do we make sure that you get your money back from the FDIC insurance? Well, if you go to the Resources tab and you look for Deposit Insurance on the FDIC's website, and you scroll down at the bottom, you'll see the FDIC has a hotline you can call, or you can go to their Information and Support Center and submit different requests. And they have the hours for the FDIC Contact Center at the bottom of this page. So yeah, that about sums it up here. We'll go over what the SIPC does in the next video. I know this wasn't really about the stock market, but many of these questions are related. So if you'd like to learn more about investing basics, this video is a part of a larger playlist that goes over just that. If you're interested in learning more, that playlist will be linked in the video description and the YouTube cards. Thanks for watching.